I would rather see the Fed eliminate paying interest on reserves, and that's what an audit, I definitely would audit the Fed. That's what an audit would reveal. I'd like to know how much of that $500 billion has gone to the top 5 largest U.S. banks. I'd like to know how much of that $500 billion has gone to foreign-owned banks.
You're watching Silver News Daily. Subscribe for more.
The cracks in our financial system are widening, and almost nobody is prepared for what's coming. For years, the Fed has pushed a narrative of controlled inflation. But what if it's all been a lie? What happens when the truth comes out, that the very currency we depend on is built on deception, debt, and empty promises? The signs of chaos are everywhere. Skyrocketing debt, suppressed interest rates, and a financial system teetering on the edge. But here's what the mainstream media won't tell you. This unraveling could ignite a silver explosion like we've never seen before. Think about it. If faith in fiat currencies collapses, where do people turn? Gold has always been the go-to, but silver, the underdog, the overlooked asset, could be poised for a historic breakout. And this time, the stage is set for something far bigger than we've ever witnessed. Advocates of honest money have been sounding the alarm, warning that the Fed's inflation deception isn't just a mistake, it's a ticking time bomb. When that bomb goes off, silver won't just rise, it could explode. So what exactly are the lies the Fed has been telling? Why does silver stand to benefit from the collapse of fiat currencies? And what signals are flashing right now that most investors are missing? Stick around, because by the end of this discussion, you'll see why silver could soon become the most valuable asset of our time.
Framed up my views. I think accurately, if I may say so. I do think honest money is not only required by our Constitution, but it's really a moral imperative. And for me, there are many biblical references to the importance of honest weights and measures. And I think it goes to the idea that really what makes us human is that we engage in commerce with voluntary transactions with other humans. And that has been a great boon to our species. And we've achieved increasing levels of prosperity because we have voluntary trade. And having a trustworthy unit of account that provides that medium of exchange for carrying out those transactions is really vital. And in Deuteronomy, in Proverbs, in Ezekiel, and numerous books in the Bible, there are references to not having differing weights in your bag. The idea going all the way back to when people would trade by having a balance that went to the market with them. And they would put on one side a weight, which represented their money's worth, and then the good they were purchasing on the other side. But if you had a heavy weight when you were buying, it was to get more than the price. It was to cheat the person selling to you. And if you used the light weight when you were selling, again, it was to deceive the purchaser, to give.
We've been led to believe that the dollar is money, secure, valuable, and reliable. But what if that belief is based on a lie? The truth is, the dollar isn't money in the traditional sense. It's currency, irredeemable currency. And understanding that difference could be the key to predicting the coming financial chaos and silver's explosive rise. Let's rewind. Before 1933, the dollar represented something real. You could take a dollar bill to a bank, slide it across the counter, and receive a fixed amount of gold or silver in return. The dollar wasn't just a piece of paper, it was a claim on tangible wealth. The value wasn't determined by fluctuating market prices, it was a weight of metal, guaranteed and redeemable. There was no guesswork, no trust required. The bank had your wealth and you could claim it anytime. But today, things are different, dangerously different. The modern dollar is irredeemable. It's no longer a promise to pay in gold or silver, it's an IOU with no redemption. You can trade it, spend it, or save it, but you can't walk into a bank and demand anything of real value in return. The wealth you think you hold in dollars is an illusion, trapped in a system designed to keep you from ever reclaiming it. Why does this matter? Because an irredeemable currency changes everything. In a redeemable system, debts cancel out when paid in real money. But when debts are paid with IOUs, like today's dollars, the debt doesn't disappear. It just shifts. The system keeps passing the burden around, creating a never-ending cycle of obligations that can never truly be cleared. The result? A mountain of debt that grows exponentially year after year. And that's exactly what we're seeing right now. But the debt problem is only the beginning. The irredeemable nature of the dollar also severs the connection between interest rates and the real market. In a gold-backed system, interest rates serve as a natural regulator. If rates fall too low, investors can demand their gold back, forcing banks to sell bonds and pushing interest rates higher. It's a self-correcting mechanism, a safeguard against economic distortion. In today's system, that safeguard is gone. The Fed controls interest rates, pushing them to zero or even negative without any natural market response. And there's nothing investors can do about it. You can withdraw your dollars, but all you're left with is more IOUs, pieces of paper that represent nothing real. The Fed finances the government finances debt, and the cycle continues unchecked. This is where silver comes into play. Silver represents something the dollar no longer does: real value. It's tangible, redeemable, and free from the promises of central banks. In a world where the currency is irredeemable and debt keeps piling up, silver stands as a form of honest money, something that can't be printed, inflated, or devalued by decree. As more investors realize the dangers of an irredeemable currency, demand for silver is set to surge. Because when trust in fiat systems evaporates, people turn to what's real. They turn to silver. But the dollar's irredeemable nature isn't its only flaw. There are deeper, systemic weaknesses, flaws so severe they threaten the entire financial order. And when those flaws become impossible to ignore, silver's rise won't just be steady, it will be explosive. That's exactly what we'll explore next.
I think those are all very, very brilliant points. We've definitely seen this bifurcation among those who live off their paycheck versus those who live off their portfolios. And we have definitely seen a patronizing attitude on the part of government trying to tell people, look, you have it so good. You couldn't be suffering inflation because look at these numbers from the Bureau of Labor Statistics. And I think it does not really capture the individual experience. And I would also note when inflation targeting was first put into use, this is kind of an interesting just little piece of history. It was New Zealand's central bank that came up with this idea. And what they said is, we need to get inflation down. Let's set up a contractual relationship with the head of our central bank, and they will state what their objective is in bringing down inflation. And if they achieve it, they get to keep their job. And if they don't, they agree they should be fired. And so there were consequences. And the New Zealand bank, followed by the Australian central bank, set up these rules and contractual arrangements with their central bank officials. And if they did not hit their target, and they set it up usually as a range of 0 to 2%, 0 to 2%, they would be fired. Nobody got fired at our Federal Reserve for having the CPI go above 9% in July of 2021 and for being incapable of getting it down to even their target 2% rate for, I think it's something like 48 months now. I might note too, since you talked about that bifurcated way that money works, where I think real financial benefits are channeled to certain members of our society at the expense of others, which really violates even the fundamental American idea of being equal under the law. When the dollar did have a link to gold during the Bretton Woods era, so roughly from the mid-40s to the early 70s, what we saw was not only economic growth, but we saw a tremendous increase in productivity. So it was productive growth, not just increasing financialization of the gross domestic product, which is what we have today. A lot of the money is just financial assets inflating. But we also saw, to your point, decreasing wealth inequality. We saw broader worker participation, but a closing of that gap as people were able to work and benefit from stable purchasing power, because you did have an international monetary system based on fixed exchange rates and anchored by a dollar convertible into gold. And I think that also helped U.S. workers in being able to compete against foreign producers of competitive products, because we had a level international monetary playing field. Whereas with the loss of that international monetary system, we opened it up to currency manipulation by our trading partners. And I think especially because of transgressions by China, we saw a hollowing out of our own productive workers who were not able to compete against not just cheap goods, but goods made cheaper because of the currency depreciation of other countries who allowed their exchange rate to decline.
The financial system's greatest illusion lies in the very currency we use every day. While most people accept the dollar as money, few stop to question what truly backs it. The Fed calls it fiat currency, legal tender by government decree. But the deeper truth is far more unsettling. The dollar isn't just fiat, it's irredeemable. And that distinction matters more than most realize. Before 1933, a dollar wasn't just a piece of paper. It represented a tangible weight of gold or silver. If you held a dollar, you could walk into a bank, slide that note across the counter, and walk out with its equivalent in precious metal. The dollar wasn't a promise. It was a contract. Gold and silver were real money, and the dollar was merely a claim on that value. But today, the dollar is an IOU with no redemption. You can trade it, you can save it, but you can't claim anything tangible for it. The bank has your wealth, and there's no way to get it back. And this is where the danger begins. Because when currency is irredeemable, it stops being a store of value and becomes something else entirely, a shifting promise with no anchor. Unlike a redeemable currency where debts cancel out upon repayment with gold or silver, an irredeemable currency allows debt to perpetuate endlessly. You pay a debt with an IOU, but the debt doesn't disappear, it simply moves around. The result? Debt keeps growing, compounding, spiraling, and we're already witnessing this in the post-2008 new normal, a financial environment drowning in exponential debt with no path to redemption. But there's more. This irredeemable currency also severs the natural checks and balances on interest rates. Under a gold-backed system, if interest rates fell too low, investors could demand their gold back, forcing banks to sell bonds or raising interest rates in the process. It was a self-correcting mechanism, a natural regulator of economic sanity. But in today's irredeemable system, that mechanism is gone. Investors are locked in. They can't demand their gold because there's no gold to demand. The Fed holds all the power, able to push interest rates wherever it wants. Zero, negative, it doesn't matter. And the public? Powerless to respond. This is the silent flaw at the heart of the financial system. A currency with no redemption, no accountability, and no escape. But what happens when trust in such a system begins to erode? What happens when investors start looking for an alternative, something real, something honest, something redeemable? That's where silver enters the story. And as we'll see next, the flaws of the dollar don't just threaten economic stability. They could set the stage for silver's most explosive rally in history.
Well, I commend you for remembering the lyrics to a pop song, and it's very apropos. I'm someone who actually goes back and reads the transcripts of the Federal Reserve Monetary Policy Committee. And if you go to 1996, July, this was a time when Alan Greenspan was the chairman. Janet Yellen was a governor. And there was a discussion around the table of what is the meaning of the stable prices mandate. And Greenspan said, in his view, it meant zero inflation. That could be the only target. And in fact, if you look at that legislation, it was from 1978. it calls for trying to reach zero inflation by 1987. So it definitely saw that as the final objective at a time when inflation was running higher. It's interesting to read the discussion because after Greenspan introduced it by saying, I think it has to mean we target zero inflation, Janet Yellen was called on. She differed. She said, I think it needs to be a low rate, but nevertheless a positive rate of 2 to 3% inflation. And in explaining her view, she drew on Keynesian theory and particularly it's called the squeaky wheel approach, greasing the wheel, and or sometimes referred to as money illusion. But it's the idea that people would not realize if they were essentially deceived on their wages if they received a higher nominal wage, let's say an increase, but relative to inflation, they were losing purchasing power, but still psychologically they could accept that. And she put forward the idea that if you had inflation of 2% and you gave someone a 1% raise, they would be happy getting a 1% raise and somehow oblivious to the fact that they were now 1%.
The dollar's irredeemable nature is just the tip of the iceberg. Beneath the surface lie two fatal flaws that threaten to collapse the entire financial system. And either one could be enough to trigger silver's explosive rise. These flaws don't just make the dollar unstable, they make it fundamentally unsustainable. Let's start with the first fatal flaw, the relentless growth of debt. In a redeemable currency system, debt has a natural endpoint. You borrow, you repay, typically with something tangible like gold or silver, and the debt disappears. But when you replace that system with irredeemable currency, everything changes. Imagine owing someone money and paying them back with an IOU. The debt doesn't vanish, it just shifts to someone else. The system keeps passing the debt along, never settling it. The result? A never-ending cycle of debt that must grow exponentially to keep the system afloat. And this isn't a theory, it's the reality we're living in right now. Since 2008, the so-called new normal has been characterized by ballooning debt levels. Governments, corporations, and households are all caught in a web of obligations that can never truly be cleared. The system relies on creating more debt to pay off the old debt. But how long can that go on? How much debt can the world absorb before the system breaks under its own weight? Now, let's look at the second fatal flaw, the complete disconnection of interest rates from market forces. In a gold-backed system, interest rates act like any other market price, self-regulating and responsive. If rates fall too low, investors pull their gold from the banks, forcing those banks to raise rates to attract deposits. It's a simple, natural feedback loop. But take gold out of the equation, and that loop disappears. The interest rate becomes whatever the Fed says it is, regardless of market realities. This disconnection has profound consequences. Interest rates are supposed to be the price of borrowing money, a reflection of supply, demand, and risk. But in today's world, rates can be manipulated to zero or even negative territory, creating economic distortions that ripple through every corner of the market. Negative interest rates sound absurd because they are. Lending money only to get back less than you loan defies basic economic logic. Yet in a system without redemption, this absurdity becomes possible. And here's the danger. When interest rates are artificially suppressed, capital misallocations become rampant. Money flows into risky ventures because there's no cost to borrowing. Asset bubbles inflate. Wealth gaps widen. The economy becomes a house of cards, vulnerable to the slightest shock. So, we're left with a currency backed by nothing, propped up by ever-growing debt, and governed by interest rates unmoored from reality. It's a fragile, unsustainable system, one that could collapse at any moment. But every collapse has a beneficiary. When confidence in fiat currency fades, investors don't just walk away, they run towards something real, something tangible, something proven. And that's where silver comes in. because silver doesn't owe anyone anything. It isn't a promise, a debt, or an IOU. It's value, real, redeemable, and resilient. And as we'll explore next, the economic philosophies underpinning today's flawed system, especially the ideas of John Maynard Keynes, have only made silver's explosive rise all the more inevitable.
See that as a win-win initiative that is actually doable. It's one thing for someone such as myself to criticize the Federal Reserve. But if you really want to have something concrete happen, to draw attention to the burden that works against individuals in the United States when you have fiscal and monetary policy that empowers government, that reduces purchasing power through no fault of their own. People have to deal with inflation, and that then requires the Federal Reserve to ratchet up interest rates. So it's a double whammy for the average American, paying higher interest rates and having to deal with inflation. If you want to change the arc of that unsustainable situation, you have to do something that's an actual program. The United States is the world's largest holder of gold reserves. We have 261 million ounces, and we have been carrying them since February 1973 at a book value at Treasury, and also recorded on the Fed's balance sheet as being worth $11 billion at $42.22 an ounce. There's a tremendous windfall profit to be captured if we were to mark those to market. And this is now being discussed in many realms because people are seeing that gold is approaching $3,000 an ounce. There's close to $3 trillion worth of windfall profit. What I'm suggesting is, first, I don't want someone to get the bright idea to just sell off our gold and take that money and give it to Treasury. And here we are running these massive deficits. To me, that's sending it down a rat hole. No. I want to make sure that can't happen. I want to lock up our gold holdings by marking them to market, but holding them as specific collateral and issuing long-term Treasury bonds. That alone will get the world's attention. A relinking of the US dollar to gold after over 50 years. And these should be made available to bondholders, and essentially the instrument, it would work much like a Treasury inflation protected security, a TIPS bond does today. It would be saying, you're willing to make a loan to the US government, but you're concerned about the possibility that purchasing power will go down over the life of the bond. Now, TIPS bond pays back, gives additional compensation in addition to the real rate of return based on the consumer price index. So you get compensated for unanticipated inflation in addition to just making a loan to the US government. What a gold-backed bond would do is say, at maturity,
Silver's story isn't just about monetary collapse and broken economic theories. It's about a perfect storm brewing in the physical market. While central banks manipulate currencies and suppress interest rates, a far more tangible crisis is unfolding. Silver isn't just a precious metal, it's an industrial powerhouse, and right now, demand is skyrocketing while supply is running dry. This lethal combination could ignite a short squeeze and price explosion, unlike anything we've seen before. Let's start with industrial demand. Silver is essential, truly irreplaceable, in technologies driving the modern world. Solar panels, electric vehicles, 5G infrastructure, medical devices, the list goes on. Unlike gold, silver has dual demand, monetary and industrial. And while investors eye silver for its role as honest money, industries are devouring it at record levels. Take solar panels, for example. Silver's unmatched conductivity makes it crucial for photovoltaic cells. The solar industry alone accounts for nearly 20% of global silver consumption, a number expected to surge as governments pour billions into renewable energy. Net zero carbon mandates across the globe are accelerating solar deployment, pushing silver demand higher than ever before. And here's the catch. There's no substitute. Silver's unique properties make it impossible to replace without sacrificing efficiency. But it doesn't stop there. The electric vehicle, EV revolution, is gaining momentum. EVs use significantly more silver than traditional cars, from battery connections to power electronics. With major automakers committing to all-electric lineups, silver consumption in the automotive sector is set to explode. And as 5G networks continue to roll out globally, silver's role in ensuring high-speed, reliable connections cements its place in the future of technology. Yet while demand surges, supply is falling off a cliff. Silver mining production has been declining, with global deficits becoming the norm. Years of underinvestment in exploration and development are catching up with the industry. Many silver mines are aging, with lower ore grades making extraction more expensive and less profitable. New projects are scarce, and bringing new mines online can take a decade or more. This supply crunch is a ticking time bomb, and it gets even more explosive when you consider the massive short positions held by institutional players. For years, big banks and financial institutions have shorted silver, artificially suppressing its price. These short positions have allowed them to profit while keeping silver prices low, but it's a dangerous game, because when physical supply tightens, and it is tightening, those shorts must be covered. And covering massive short positions in a market with dwindling physical supply, that's a recipe for a violent price spike. We've seen glimpses of this before. The Hunt brothers' attempt to corner the silver market in the late 1970s triggered a meteoric rise, pushing prices from just over $6 to nearly $50 per ounce. While their story ended in forced liquidation, the underlying lesson remains. Silver's market is thin and volatile. A rush to cover shorts, combined with surging industrial demand and a shrinking supply base, could send prices skyrocketing in days. But this time, the setup is even more explosive. The drivers aren't just speculative, they're structural, fundamental, and global. Industrial demand isn't slowing, it's accelerating. Supply isn't expanding, it's shrinking. And the financial games that have kept silver prices suppressed for years are nearing their breaking point. When the short squeeze hits, when institutions scramble to cover positions and industries compete for dwindling supplies, silver's price won't just rise, it will explode. And for investors paying attention, this could be the opportunity of a lifetime. But there's one final piece to this puzzle: timing. All the forces are aligning. Monetary chaos, supply deficits, industrial booms, and looming short squeezes. The question now is simple. Why now? Why is this moment different? And why could silver's rise be more explosive than ever before? That's exactly what we'll uncover next.
See that you have crashes like 2008. I mean, the Federal Reserve was really set up to prevent these massive breakdowns. But even Bernanke said that what happened in 2008 had worse consequences than the Great Depression. So what do we gain from having a Federal Reserve? Because I think you could make the argument there was no other institution that could be deemed more responsible for miscalibrating the amount of money and credit in the world leading up to the 2008 global financial meltdown than the U.S. Central Bank. I mean, they had the most power to control money and credit. So it's reasonable, if radical, to say, why not end the Fed? I have tremendous respect for Ron Paul. And I proudly say that radical solutions are something likewise to be proud of. Radical, again, going to the Latin, refers to the root, getting to the fundamental issue, which brings us back to trustworthy money. Can the Fed deliver it? I won't say at this point whether to end the Fed, but should we reform it? Should there be limits on how much government debt the Federal Reserve can purchase, how much federal debt it can monetize, how much purchasing power it can create literally out of thin air with a keystroke by crediting the reserve balance accounts of the member banks who are required to have cash accounts at the Fed. When it buys Treasury securities from those institutions, it merely writes up the amount of cash in their accounts. The Fed, that's a power it has, should it. should there be limits on how much money the Federal Reserve can pay banks to keep that money sitting in cash? That's something relatively new. It was only after 2008, as part of an emergency package, that the Federal Reserve gained the right to pay interest on those cash accounts that banks must keep at the Federal Reserve. But now that has become the primary tool the Fed uses. It doesn't try to fight inflation the way Paul Volcker did by buying and selling Treasury securities. It just, more in keeping with what the old Soviet Государственный Gosbank, the old Soviet state bank, used to do during the era of the Soviet Union, which is to just dictate the interest rate, not with any regard to market forces, but just dictate it. And the Federal Reserve now pays, currently it's paying 4.4% on those cash accounts. And since it started paying very, very high interest, and that started in March of 2022, so in less than those 3 years, we're coming up on the 3-year mark, over $500 billion has been paid by the Federal Reserve in the form of interest to those banks, paying them not to lend that money out. Keep it in cash, sitting in your deposit account at the Fed. That, I think, if the American public was aware of it, would rub people the wrong way for two reasons. One, if the Fed was not...
Silver's story isn't just about monetary collapse and broken economic theories. It's about a perfect storm brewing in the physical market. While central banks manipulate currencies and suppress interest rates, a far more tangible crisis is unfolding. Silver isn't just a precious metal. It's an industrial powerhouse. And right now, demand is skyrocketing while supply is running dry. This lethal combination could ignite a short squeeze and price explosion, unlike anything we've seen before. Let's start with industrial demand. Silver is essential, truly irreplaceable, in technologies driving the modern world. Solar panels, electric vehicles, 5G infrastructure, medical devices, the list goes on. Unlike gold, silver has dual demand, monetary and industrial. And while investors eye silver for its role as honest money, industries are devouring it at record levels. Take solar panels, for example. Silver's unmatched conductivity makes it crucial for photovoltaic cells. The solar industry alone accounts for nearly 20% of global silver consumption, a number expected to surge as governments pour billions into renewable energy. Net zero carbon mandates across the globe are accelerating solar deployment, pushing silver demand higher than ever before. And here's the catch: there's no substitute. Silver's unique properties make it impossible to replace without sacrificing efficiency. But it doesn't stop there. The electric vehicle, EV revolution, is gaining momentum. EVs use significantly more silver than traditional cars, from battery connections to power electronics. With major automakers committing to all-electric lineups, silver consumption in the automotive sector is set to explode. And as 5G networks continue to roll out globally, silver's role in ensuring high-speed, reliable connections cements its place in the future of technology. Yet while demand surges, supply is falling off a cliff. Silver mining production has been declining, with global deficits becoming the norm. Years of underinvestment in exploration and development are catching up with the industry. Many silver mines are aging, with lower ore grades making extraction more expensive and less profitable. New projects are scarce, and bringing new mines online can take a decade or more. This supply crunch is a ticking time bomb, and it gets even more explosive when you consider the massive short positions held by institutional players. For years, big banks and financial institutions have shorted silver, artificially suppressing its price. These short positions have allowed them to profit while keeping silver prices low, but it's a dangerous game, because when physical supply tightens, and it is tightening, those shorts must be covered. And covering massive short positions in a market with dwindling physical supply, that's a recipe for a violent price spike. We've seen glimpses of this before. The Hunt brothers' attempt to corner the silver market in the late 1970s triggered a meteoric rise, pushing prices from just over $6 to nearly $50 per ounce. While their story ended in forced liquidation, the underlying lesson remains. Silver's market is thin and volatile. A rush to cover shorts, combined with surging industrial demand and a shrinking supply base, could send prices skyrocketing in days. But this time, the setup is even more explosive. The drivers aren't just speculative, they're structural, fundamental, and global. Industrial demand isn't slowing, it's accelerating. Supply isn't expanding, it's shrinking. And the financial games that have kept silver prices suppressed for years are nearing their breaking point. When the short squeeze hits, when institutions scramble to cover positions and industries compete for dwindling supplies, silver's price won't just rise, it will explode. And for investors paying attention, this could be the opportunity of a lifetime. But there's one final piece to this puzzle: timing. All the forces are aligning: monetary chaos, supply deficits, industrial booms, and looming short squeezes. The question now is simple: why now? Why is this moment different? And why could silver's rise be more explosive than ever before? That's exactly what we'll uncover next.
Is insulated from rule of men. It's determined by rule of law. And I think that's much more consistent with our framework for government, and with the idea that it's a government that serves the people and not vice versa. Being able to manipulate the value of the dollar by controlling the cost of capital and interest rates in a free market society is tantamount to saying that money should serve as yet another tool of economic control by the government, rather than being, as you started out saying, this vital planning instrument that every family, every individual uses to make decisions about what to buy, what to sell, what to produce, what to consume, whether to work or engage in leisure, whether to save money, whether to invest it. The whole idea of a free market economy works in delivering optimal outcomes, meaning maximum prosperity to participants, when price signals are accurate. And in order to convey accurate price signals, the money has to be meaningful and dependable. So it's really the oxymoron in saying stable inflation is somehow a goal. If it's stable, it's not inflating. But I think it also shows how incongruent that concept is with a free market economy that needs price signals so that transactions take place where supply and demand meet. And that has to be at a price that then reflects those forces. And when that gets distorted because the unit itself doesn't convey accurate price signals, then I think you're in trouble of the sort that we've seen. It really shows up in malinvestment and distortions and decisions about long-term capital projects.
The moment of truth is here. All the forces we've discussed: monetary deception, irredeemable currency flaws, Keynesian economic repression, industrial demand surges, supply shortages, and looming short squeezes, are converging right now. The timing couldn't be more critical. Silver isn't just positioned for a rally, it's on the brink of a historic explosion. So why now? What makes this moment different from every silver surge we've seen before? The answer lies in the scale of the crisis and the strength of the catalysts. We're not just dealing with inflation or interest rate manipulation. We're staring down a potential collapse of confidence in the entire fiat currency system. The Fed's inflation narrative is unraveling. Central banks around the world are trapped. Raising rates risks a financial meltdown. Lowering them fuels inflation and asset bubbles. There's no escape. Meanwhile, the industrial revolution of the 21st century, green energy, electric vehicles, 5G technology, is unfolding at breakneck speed. These sectors don't just want silver, they need it. And as demand accelerates, supply is stuck in reverse. The silver market is heading straight for a supply-demand collision, and the impact could shatter price expectations. But the real trigger? The short squeeze. Institutional players have suppressed silver prices for years with massive short positions. As physical silver becomes scarcer, these shorts will be forced to cover, igniting a buying frenzy that could send prices soaring overnight. We've seen this play out in other markets, but this time it's silver's turn. And given the metal's thin market and dual demand, the price surge could be explosive. This isn't speculation. It's a logical outcome of economic forces that can no longer be contained. The Fed's inflation lies have laid the groundwork. The irredeemable currency system has weakened the financial structure. Keynesian policies have crushed savers and distorted markets. Now, with industrial demand booming and supply dwindling, silver is set to explode. The window of opportunity is closing. Silver remains one of the most undervalued assets on the planet, but not for long. When the dam breaks, silver's price could surge beyond anything the market has ever seen. The question isn't if it will happen, it's when. So, are you ready? Because silver's time has come, and those who recognize the signs now will be the ones who benefit the most. Don't forget to subscribe for more insights on the silver market and how you can stay ahead of the financial reset. And remember, this is not financial advice. Always speak to a professional before making any financial decisions.